Matt Comyn, good to catch up. Now, the bank's cash net profit down 11.3% to $7.3 billion. A result for the Times, really. How has the bank been managing through the pandemic?
Well, overall, I think very well, and I'm very grateful for all the hard work from our people in particular. We've put substantial support in place for our customers, responding to more than 1 million requests for assistance. We're also fortunate we came into this period in very strong health overall, both from a capital perspective and our balance sheet. And so we've been able to provide that support, as I said, but also make sure that we're able to continue to operate and perform very well in some of our core markets like home lending, deposits, business lending. And so overall, I think the result's a strong one given the very challenging context that we're all operating in.
Let's talk about your customers, both on mortgages and also business customers, because you were trying to pull down the amount of deferring of payments. You've done a little bit of that, but then we've had the Melbourne shutdown.
We've seen about 20,000 or so customers from our home lending business come out of their repayment deferrals, and about 30% come out of business lending. Now, of course, they're 6 months deferral, so these are customers opting to come out of them early. And understandably, many customers, even those outside of Victoria or perhaps in sectors that haven't been as heavily impacted as we all would have thought going back to March, feel that there's a degree of uncertainty, so they've preferred to stay in the repayment deferral.
But where do you see it now? Do you see that coming down more, or do you see people thinking, no, I've got to keep deferring?
I mean, overall, so with the numbers that we put out today, they were down. That was at the end of July, and as we're watching closely during the month of August, as you'd imagine, it's still continuing to come down, but we certainly have seen a slight uptick, as you'd expect in Melbourne, and so it'll probably be around flat for the month of August would be my guess, and then over the next couple of months, for many customers, they'll be coming towards the end of that 6-month repayment deferral at the end of September. And so we'll be working on the best solution on a case-by-case for them to make an orderly transition out of those repayment deferrals.
So your loan impairment expenses jumped to $2.5 billion. You gave some colour around risk. Now, if you look at your mortgage holders, you say 67% have a loan-to-value ratio of over 80%. I mean, I guess that means that 33% don't. Now, how many of those, for example, would be on JobSeeker?
Yeah, so the way we sliced and diced it to try and give our investors and the broader market much greater transparency, and dynamic LVR, or how much equity someone's got in their home, is an important metric, and so it was 67% less than 80%, so that overall the average dynamic LVR is about 69%, so 30% of equity.
But that means a third are not in that.
That's right, but if you think about the average being at 69%, it's sort of a narrow band. In WA, it's slightly higher in terms of LVR because the market has fallen there.
So you're not worried about defaults coming? I mean,
no, I mean, look, we'd worry about it from an individual customer perspective. I mean, at an average LVR of about 69%, or in Victoria, it's an average LVR of 62%. Clearly, there's quite a bit of a buffer there, but that's not to say that that's not a very challenging set of circumstances for an individual customer.
And on businesses, you say 30% are using JobKeeper. So what does that mean about, I mean, are these real jobs, do you think, and what is the state of your small business customer?
Yeah, we've looked through that, and interestingly, as we've seen the business customers in repayment deferrals, we've seen 30% of them, notwithstanding the fact that they're in a repayment deferral, continuing to make their repayments in full. But you're quite right. I mean, JobKeeper has been a very effective and targeted support, or income support, for many small businesses.
But how much is it masking what is really going on?
Well, certainly to some extent, and what we've got to hope for as the tapering, understandably, starts to come through in the next few months and into early next year, that the health situation's in a sufficiently good position, and there's effective suppression around the country, that more and more sectors will be able to restart.
But do you see an inevitable extension of JobKeeper and JobSeeker?
Well, I think it will depend. I mean, if you look at some states, the health record is actually very strong. On a global basis, Australia's doing extremely well. But I mean, New South Wales, obviously a very big part of the overall domestic economy, very effective management of a complex, large population. And so they've been able to keep that caseload to very low, and a very small number of cases where they haven't been able to track the source of the transmission. That's a really important
But does that mean management should be now on a state basis rather than a national basis if you're thinking of JobKeeper and JobSeeker?
Yeah, I mean, absolutely. And the federal government, I think, shown a willingness to be flexible and to have more effective targeting, both on the basis of qualification. But of course, for us, and I'm sure many businesses, we look at a very granular level and we're seeing quite divergent outcomes across different parts of the country as well as in different sectors. There are some sectors, travel, tourism, airlines, which are going to take a long time before they're going to recover, whereas at least in some sectors of hospitality, pubs, clubs, depending on where they're operating, we've seen them bounce back quite strongly. So I think it is going to be a very different set of experiences for individuals, for businesses, which is of course unfair and unfortunate. We recognise that. We're going to try to support our customers as best we can.
Now, for your shareholders, a dividend. Now, you've actually paid out really up to as much as you could, according to what the regulator would like to see, so 50% of statutory earnings. What was the thinking there?
Yeah, well, we're obviously conscious of a couple of things. First and foremost, we came into this situation a very strong capital position. We finished the full year at 11.6% of Common Equity Tier 1, which is a $5 billion surplus over and above the regulatory requirement. It also weighed on our minds in the context of our shareholder base. We've got almost 900,000 individual Australian households who own our shares directly. And so we recognise how much the dividend means to them. And of course, it's not an annuity, but we certainly thought long and hard about that. As you mentioned, the calculation that's consistent with the guidance, the clear guidance from APRA is around statutory profit. Our statutory profit was actually up this year.
Well, that begs another question. It may not be going forward. And looking at your cash earnings, are you going to be able to maintain dividends as the pandemic continues?
Well, of course, that's going to come down to a number of different factors, including some of the things that we've been talking about in terms of just the outlook more broadly in the economy. We do benefit from the gain on sale of divestments this last financial year, and because of that capital position, we were able to pay at the top end of that 50% guidance at 98 cents or 49.95% of our statutory profit. And as we look forward, of course, we'll be thinking about a number of different settings, but really there's so much uncertainty in the economic outlook, but we feel we're very well prepared for a range of different economic scenarios.
You, just on your remediation, in terms of remediating customers for over financial advice, you've recently made an additional $300 million provision. What's the timing on this, Matt? Because again, the regulator is concerned about when people are going to be repaid.
Yes, and look, we've been able to complete a number of remediations, more than $1 billion of refunds back to customers. The aligned advice remediation is taking too long, so I share that sentiment. We did increase the provision. It took a lot of work to get to the stage, so we had actually some information to reliably estimate. In some cases, we're having to go back to 2008.
Can you not fast track it?
We're trying to fast track it. There's a number of different considerations, but we certainly recognise the expedient approach is preferred by all stakeholders. We've provided for it. We continue to incur costs from holding the remediation fund, so there's no benefit from a financial institution not distributing it as quickly as possible.
Right. Your reputation is improving, your Net Promoter Score is improving. On the Financial Counselling Australia's ranking, though, you ranked at the bottom of the Big Four when it came to hardship provisions. Now, that was before the fires and COVID. How do you think you'd be ranking now?
Well, hopefully very well. We had been at the top of that survey, and we've worked closely with the Financial Counsellors Association. They do a great job and provide an essential service. We were disappointed with where we ranked at the end of last calendar year. We feel that we understand the things we need to work on. We're confident we've improved those. As you said, during the course of this calendar year have been big improvements in Net Promoter Score and reputation more broadly. We finished the financial year, our digital NPS, the highest ever, and I think a clear leader as the best digital bank in Australia. And all of those things are important, and we want to make sure that we're continuing to get better every day for our customers.
Finally, let me ask you about the outlook and business confidence, consumer confidence, so important.
Absolutely. I mean, it's really going to underpin, I think, the shape of the recovery. And to an extent, certainly, I think that it has been impacted by what's happening in Victoria. And the health outcomes that we're seeing on a day-to-day basis, the number of cases, and there's no question that that's feeding through into consumer and business confidence. And so I think when the community more broadly feels confident about the adequate management and suppression, and as I said earlier, I think the government at both the federal and state have done a great job, notwithstanding the setback in Victoria. On a global basis, we compare tremendously well.
So if they can open up Victoria by mid-September, that would be good news.
Absolutely. I mean, every piece of that helps. And of course, we've got to make sure that we've got an adequate suppression and again, to that point around confidence, but clearly more parts of the economy that can be restarted, more mobility, more job creation, less dependence on income, support from the federal government, because we're going to need stimulus in a number of different ways to try and create more aggregate demand in the economy and boost employment in the years to come.
Matt Comyn, thank you so much.